Good day Forex trader. Your USD looks firm and approaches 1.1300, EMU CPI in sight. Your USD extends the upside to the boundaries of 1.1300. Final January EMU CPI next of note in the domestic calendar. US ADP report will be the salient event later in the NA session. The upside momentum around the shared currency remains everything but abated and now lifts EUR/USD to fresh multi-day highs near 1.1300, the figure on Wednesday. Your USD strong on USD selling. Your USD advances uninterruptedly since Friday on the back of now deep correction in the US dollar, recovering at the same time nearly half of the sell-off witnessed in the second half of January. As mentioned, the greenback continues to lose ground on the back of the moderate improvement in the risk appetite trends, lower US yields and the perception of a less aggressive start of the Fed's liftoff, as per recent comments from some Fed speakers. The strong rebound in spot comes along the bounce in yields of the German 10-year Bund reference to the positive territory on a more convincing note, as they manage to flirt with the 0.05% level for the first time since April 2019 on Tuesday. In the docket, the focus of attention will be on the release of the final inflation figures in the broader Euroland for the month of January. In the US data sphere, the job creation by the US private sector tracked by the ADP report will be the salient event later on Wednesday. What to look for around Your USD extended the bounce off 1.1120, January 28, and now retargets the 1.1300 barrier amidst improved risk appetite trends and the renewed selling mood in the dollar. Moving forward, the outlook for the pair remains far from rosy despite the rebound, particularly in light of the Fed's imminent start of the tightening cycle versus the accommodative for longer stance in the ECB, despite the high inflation in the euro area is not giving any things of cooling down for the time being. On another front, the unabated advance of the coronavirus pandemic remains as the exclusive factor to look at when it comes to economic growth prospects and investors' morale in the region. Key events in the euro area this week: EMU flash January CPI, Wednesday; EMU, Germany final January services PMI, ECB meeting, Thursday; EMU retail sales, Friday. Eminent issues on the back boiler: asymmetric economic recovery post-pandemic in the euro area. ECB stance/potential reaction to the persistent elevated inflation in the region. ECB tapering speculation/rate path. Italy elects President of the Republic in late January. Presidential elections in France in April. Geopolitical concerns from the Russia-Ukraine conflict. Your USD levels to watch. So far, spot is gaining 0.13% at 1.1285 and faces the next up barrier at 1.1294, weekly high February 2, seconded by 1.1304, 55-day SMA, and finally 1.1369, high January 20. On the other hand, a break below 1.1121, 2022 low January 28, would target 1.1100, round level, en route to 1.1000, psychological level. GBP USD Forex signal: sterling rebound has more room to run. There is a likelihood that the pair will continue rising ahead of the BO decision scheduled for Thursday. Bullish view. Buy the GBP USD pair and set a take profit at 1.3610. Add a stop loss at 1.3450. Timeline: 1 to 2 days. Bearish view. Set a sell stop at 1.3480 and a take profit at 1.3400. Add a stop loss at 1.3550. The GBP USD held steady on Wednesday morning as investors reflected on the strong economic data from the UK and US. The pair rose to a high of 1.3510, which was the highest level since January 27. It has risen by more than 1.1% from its lowest level last week. UK economic data. The UK economy is doing relatively well even as the political climate worsens. Data published on Tuesday showed that the country's home prices continued rallying in January. According to the Nationwide Society, the UK Home Price Index, HPI, made the best start of the year in 17 years. Precisely, home prices rose by 11.2% in January after rising by 10.4% in December last year. This strong growth is mostly because of the relatively low mortgage rates. Other factors that have contributed is the rising demand and low inventories. Most importantly, the cost of building new homes has been on an upward trend. Further data published by the Bank of England revealed that mortgage approvals jumped to 71.02k in January after rising by 67k in the previous month. In total, banks provided mortgages worth more than £3.57 billion during the month. Meanwhile, according to Market, the manufacturing sector also did well in January. The manufacturing PMI rose to 57.3, which was better than the median estimate of 56.9. Therefore, the GBP-USD pair rose because of the upcoming interest rate decision by the Bank of England. Analysts expect that the bank will hike interest rates by another 25 basis points tomorrow. The next key catalyst for the pair will be the ADP estimate of U.S. private sector payroll numbers. Analysts expect the data to show that the economy added over 201k jobs in January. On Tuesday, data by the government showed that there were more than 10 million vacancies. GBP-USD forecast. On the 4-hour chart, we see that the GBP-USD pair has been in a strong bullish trend in the past few days. The pair has managed to move slightly below the 38.2% Fibonacci retracement level. It has also jumped slightly above the 25-day and 50-day exponential moving averages, EMA. The pair is also approaching the first support of the Andrews pitchfork tool. Therefore, there is a likelihood that the pair will continue rising ahead of the bow decision scheduled for Thursday. If it happens, the next key level to watch will be at 1.3610. AUD-USD Forex signal, extremely bullish for now. The pair will likely keep rising as bulls target the next key resistance level at 0.7150. Bullish view. Buy the AUD-USD pair and set a take profit at 0.7165. Add a stop loss at 0.7050. Timeline, 1 to 2 days. Bearish view. Set a sell stop at 0.7085 and a take profit at 0.7000. Add a take profit at 0.7150. The AUD-USD darted higher as investors started pricing in a rate hike by the Reserve Bank of Australia, RBA. The pair rose to 0.7115, which was the highest level since January 26. It has risen by over 2% from its lowest level last month. RBA ends QE. The main catalyst for the AUD-USD pair is the Rba meeting that took place this week. On Tuesday, the RBA concluded its first meeting of the year and provided hints that it will start hiking interest rates later this year. In the statement, the bank also said that it will end its yield curve control and quantitative easing, QE, program. In the QE program, the bank has been buying bonds worth billions of dollars every month. These funds have contributed to lower borrowing rates for both Australians and the government. On interest rates, the bank said that it will only start hiking them when it is confident that the real inflation has moved between the 2% and 3% band. The bank expects that the headline inflation will remain above 3.7% this year and then start retreating in 2023. Analysts expect the bank to be data dependent going forward. Still, with most banks like the Fed and the Bank of England expected to hike, there is a likelihood that the RBA will move in the third quarter of this year. This explains why the AUD/USD pair rose sharply after the RBA decision. The pair will next react to the latest American jobs numbers. ADP will publish the latest private payrolls numbers later today. Analysts expect these numbers to reveal that the country's private sector created over 200k jobs in January. These numbers will come 2 days ahead of the official jobs data. AUD-USD forecast. The 4-hour chart shows that the AUD-USD pair has made a spectacular recovery in the past few days. It has risen from a low of 0.6968 to a high of 0.7118. As it rose, the pair managed to move above the key resistance level at 0.7083, which was the lowest point in November. It also moved above the 25-day moving average and is along the upper side of the Bollinger Bands. Therefore, the pair will likely keep rising as bulls target the next key resistance level at 0.7150. However, a drop to the middle line of the Bollinger Bands cannot be ruled out.